In this video, we look at the FRDI, or the Financial Resolution and Deposit Insurance Bill. There has been a lot of talk and a lot of controversy regarding this bill, so it's important to separate the fact from the fiction. So let's look at the basic purpose of this bill. This bill outlines how the insolvency of a financial intermediary, such as a bank or even insurance firms, can be tackled. The need for this bill came about because of the 2008 crisis, in which a large number of financial institutions were brought to their knees, and because of which governments had to bail out a large number of these institutions. We look at these word bailouts in further detail later on, but for the time being, let's move on to the origins of this bill. So coming to the origins, this bill is based on a 2014 working paper of the Reserve Bank of India. And as I already mentioned, this is a global move to contain the contagion effect that occurred in 2008 in the financial crisis. As India is one of the G20 nations, it had agreed to create a structure that had a bail-in provision to recapitalize banks. We will look at this word bail-in later on. However, at this point in time, we have to remember that this bail-in provision is only a matter of last resort. So what is the current situation and what is the change proposed by this bill? So this bill envisages the setting up of a resolution corporation which will replace the Deposit Insurance and Credit Guarantee Corporation, or the DICGC, which is an arm of the RBI. This arm offers an insurance cover of up to Rs 1 lakh to depositors. So let's take a simplified example to understand this. Imagine that I go to a bank today and open a fixed deposit of Rs 10 lakhs. Now suppose that this bank lends money to a company which does not return the money back to the bank. So imagine that this bank goes bankrupt because of this one loan. Now, since I have a fixed deposit of Rs 10 lakh in this bank, as per the existing law, I am guaranteed only this 1 lakh out of the 10 lakh that I have deposited. The rest I may or may not get. However, there is an implicit sovereign guarantee, which means that the government will make sure that I get the money that I have deposited. However, under the proposed law, what will instead happen is a different process called as a bail-in, which will be followed by this resolution committee that will be set up. And this proposed corporation has multiple functions apart from the liquidation part of it, which is to closely monitor companies, classify them as per risk profiles, and then step in the case of a failure, which I talked about. So let's look at this process in a little more detail. So to understand this, we need to understand the difference between a bail-in and a bailout. A bailout involves the rescue of an institution by the government using taxpayers' money. We have seen multiple examples of this during the 2008 financial crisis. Examples include AIG, Goldman Sachs, General Motors, etc. A bail-in, on the other hand, is where the financial institution is rescued by making the creditors and the depositors take a loss on their holding. This is exactly the reason for the general panic among the public right now. So in the previous example that I took, as per the current provision, I am guaranteed Rs 1 lakh as per the DICGC, and also, as I mentioned, there is an implicit guarantee of the government, which is that the government will not let a bank collapse and will bail it out, as has been the case previously. However, under this new bill, the creditors and the depositors will have to bear the brunt in the event of a bail-in. The bill does not specify the amount that the depositors are guaranteed, and hence there is a lot of confusion regarding this point. A few more points in relation to this. The resolution committee that we talked about will be set up under the finance ministry, whereas the DICGC, which is the current setup, is currently under the RBI. The bill also provides a 1-year time for the committee to resolve the issues and to extend the time frame to another year if needed. This is to ensure speedy resolution of the issue. So, what is the current situation? The bill is not as drastic as it sounds. Till date, the RBI has always ensured that the bank has never collapsed, and it is equally likely that the committee will continue to do so. Also, the finance ministry has mentioned that the government's implicit guarantee remains unaffected in the wake of rumors. However, it would be wise on the part of the finance ministry to communicate this effectively to the Indian public, which would prevent a panic-like situation happening, which could lead to a run on some weaker banks. On the whole, though, leaving the ambiguous liquidation part aside, the bill has certain benefits compared to the current system, the main one being the time-bound resolution process as defined in the bill. I hope this video has been useful to you. If so, please like the video and subscribe to our channel for more updates. Also, feel free to get back to any of us at Learning Roots in case you wish to get your doubts cleared. If you are an MBA aspirant, we'll be starting a GDPI course where we'll be sharing more such videos. Join the Facebook group linked in the description below for updates.